The Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. We're talking about mutual funds. And if you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. You can also go to my website, which I encourage you to do, at jareddillianmoney.com, where you will find all kinds of resources, some free, some not, but all very, very valuable. And you can also follow me on Twitter at DailyDirtNap. And let's talk a little bit about the different kinds of mutual funds. There are basically three kinds of funds. And one is called an open-end mutual fund, and that's really the one that I'm talking about. I'm talking about open-end mutual funds. And so take Fidelity, for example. They have a mutual fund. You send them $1,000. You are invested in the fund at the closing price of that day, and you get shares in return. And that fund reprices once a day. It's not traded on an exchange. If you want to trade it, you trade it with Fidelity. Fidelity is your counterparty. And it's not traded on an exchange, and that's it. You hold it with them. You pay an operating expense ratio, which is generally around 1%, less these days, maybe around 70 or 80 basis points. And that's it. Now, they have different types of open-end mutual funds, and some have fees and some don't. They're called loads. Okay, so a mutual fund that has fees is called a load fund, and a mutual fund that doesn't have fees is called a no-load fund. And when I refer to fees, I mean sales charges. I mean transaction fees when you buy the mutual fund. And there's front-end loads, which are fees when you buy the fund, and then there's back-end loads, which are fees when you sell the fund. Front-end loads are more common. It's pretty rare that a fund would have both front-end and back-end loads. What is the purpose of these sales charges? Well, there are actually two. One is it pays for the marketing and distribution of the funds. So if you get a mutual fund through a broker like Edward Jones, the sales charges that you pay for the marketing and distribution of the funds. Pays Edward Jones. The other reason that there are loads is to keep you invested in the fund. And I've said before, I say this a bunch of times, that high fees are not your enemy. I mean, yes, fees eat into returns over time, but mutual fund fees, sales charges, provide a powerful disincentive to sell out of the fund. A powerful disincentive, because if you ever wanted to buy back in, you would have to pay that sales charge again, and nobody wants to do that. So even though, yes, I'm against fees, I like low fees, but sometimes I actually like high fees because they actually help. Now, they have these things called closed-end funds, and a closed-end fund is a mutual fund that basically has an IPO. It raises a bunch of money, and it buys stocks, and it trades on an exchange. So the interesting thing about a closed-end fund is that the share price, can deviate from the actual value of the fund. And sometimes it trades at a discount, and sometimes it trades at a premium. And sometimes the discount or premium is pretty big. And there's no reason to buy a closed-end fund at a premium ever. And when it's trading at a discount, you're actually sort of getting something on sale. So it's kind of a good deal. The one thing you cannot control for is that if you buy something at a discount, it could get to an even bigger discount. And the discount and premium is really a function of supply and demand for the shares. It doesn't really have much to do with the value of the fund. Now, they also have something called ETFs, exchange-traded funds. ETFs is what I did for my career for a number of years on Wall Street. I was an ETF trader at a bank, Lehman Brothers. And those were some interesting times. ETFs have been around since, I want to say, in the U.S. since about 1996, 1997. There are thousands of them now. It's you can just think of them as a mutual fund that trades on an exchange, but that's not really accurate. There's a pretty significant difference in the legal structure that makes them different. I can't really get into it here. But you can think of it as a fund that trades on an exchange. And unlike a closed-end fund, there will not be a discount or a premium. The shares will pretty much trade on top of the value of the fund. Okay. Yes, so open-end funds, closed-end funds, and ETFs. And what I recommend when you start investing, as you begin your investing career, is that you actually focus on open-end funds. Open-end funds. And let me tell you why. I don't want you to stare at the price of a closed-end fund or an ETF in your brokerage app. Because people love to, I mean, you know what I do actually? I'm gonna tell on myself here. I'm gonna tell on myself. I own Bitcoin and I love to check on it. I pull it up, not a lot. I'm not like 20 times a day, but I pull it up like 2 or 3 times a day. And it gives me, if it's up, it gives me a little shot of adrenaline, and if it's down, I'm like, oh. And you know what? That's kind of, that's recreational fun for me, okay? Because it's not a big amount of money and it's just fun. But for your retirement funds, for your like long-term investments, you don't want that shot of adrenaline. You don't want to feel anything at all. You want none of that. You want it to be boring. You want to forget about it. You don't want to look at your investments ever. You want to look at it like once every 6 months and just forget about it. Because remember, that's the whole point. You want to hire an outside money manager, a portfolio manager, and have him manage this money for you. Got it? Okay, so stuff that trades on an exchange is no good. You'll be watching it all the time. What are some mutual fund companies? Now, this isn't an endorsement of any mutual fund company. I'm just going to name some of the bigger ones. Now, in terms of no-load funds, the biggest are Vanguard, and Vanguard is special because they have low-cost funds. Fidelity, T. Rowe Price, and Janus. I would say, unless I'm missing somebody, I would say those are 4 of the biggest mutual fund companies that have no load or funds without sales charges. Okay. As for funds with sales charges, there are a lot of them. A couple examples are PIMCO. PIMCO is typically a fixed income, a bond money manager, and their funds have sales charges. And American Funds is one you probably heard of. I mean, you might even own some of their funds. They are primarily distributed through through Edward Jones, and yeah, they're called Capital Group, and American Funds has lots and lots of mutual funds and their load funds, and they're distributed. So, lots of people, when they want to invest in mutual funds, they only look for the no load option, and usually you get the load funds through a broker. The loads, as I said, they pay for distribution and marketing of the funds. So, as I mentioned, Edward Jones is the primary means of distribution for American Funds, which is Capital Group. They're based in Los Angeles. Now, if you're going to buy a load fund, if you're going to buy a fund with a sales charge, choose wisely, because you don't want to be trading it around. A year later, you don't want to say, whoops, I shouldn't have bought that, and then you're selling it, and then you're buying something else, and you're chopping yourself to bits, and you're spending all this money on commissions. No. You want to choose wisely. And this is typically, where a broker or a financial advisor can come into play and help you build that portfolio. You probably don't have any experience building a portfolio. He's going to put you in some stocks. He's going to hopefully put you in some bonds, although that happens less and less nowadays. And you're going to have a mix of stocks and bonds. You're going to have a mix of growth and value. You're going to have a mix of small cap and large cap. And you're going to have a mix of U.S. and international. And you're going to have this diversified portfolio, and you're going to want to leave it alone. So if you've invested in funds with sales charges, then stay in them. Choose wisely. And remember, we are not afraid of high fees because high fees tend to discourage stupid behavior. Volatility. The purpose of volatility is to make you make stupid decisions. And all of this, by the way, is better than messing around with individual stocks, which is a rich man's game. Messing around, screwing around with individual stocks is a rich man's game. You don't really have any business doing it. You don't. Unless, I would say, ideally, you should have multiple six figures in assets before you start thinking about building a portfolio of stocks. And the reason is that if you're going to build a portfolio of stocks, you really need 20 or 30 stocks, which means you need a lot of money. And if you don't have 20 or 30 stocks, if you just have 2 stocks, like a cannabis stock and a blockchain ETF, then what you are doing is screwing around. Now, you might say you're getting an education in the markets, you're learning something. Okay, then call it an education, but don't be under any kind of illusion that this is helping you in any way, shape, or form. You're just screwing around. So which is one of my objections to these brokerage accounts with no commissions, is that it encourages people to screw around. Yes, So individual stocks, you might want to wait until you have multiple six figures in assets. Let the professionals pick stocks. These guys are good. You know what a lot of these guys have? They have something called the CFA, and that stands for Chartered Financial Analyst. And the Chartered Financial Analyst program is a certification program for professional investors, and you have to study a lot of junk and pass exams. You have to pass 3 different exams. Now, I passed the first exam, and I flunked the second exam, and I gave up. And I'm a pretty smart guy, and it's hard. I don't necessarily like the curriculum of the CFA, but these guys that pass this exam work their asses off. I mean, it's insane. It is a huge amount of work, and it's a lot of pressure, and they give the exams once a year. And my guess is that your portfolio manager at a mutual fund company has a CFA, and he has learned a lot about managing portfolios. These guys also make a lot of money. It is a high-pressure job. They rank the mutual funds, and if you are on the bottom, you get fired. That is how it works. There's a lot of competition, and the competition is getting worse and worse. So this whole thing with investing is easier than ever. They have this thing called the internet. When I was doing it, they had Money Magazine, and I had to mail checks. You pick out funds. You link them up to your bank account. You set up automatic withdrawals. It is a piece of cake. But remember, first, you want to build up your $10,000 in emergency funds first. And no debt. And then you can invest in mutual funds. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.